Okay, hello and welcome to part 2 of module 10, where we're going to cover how to prepare for central bank trading opportunities. Now this video and this module, this part of the module at least, is like I said in the last video, pretty much the crux or the centerpiece behind prepping for um, central bank trading events. So I'd say pay special attention to what I'm saying in this part of the module, because this is very, very, very important in understanding how to execute and how to actually build a process that you can replicate time and time again and get consistent results. So like anything we're trying to do with this, um, or like anything that we're trying to do actually in any course or any sort of endeavor in trading, you want to build a process. So what we're trying to do here, like we just said, is build a process oriented approach. Now, in trading these events, I would say there's probably 5 very key steps in trading them. So we're going to start with the first, which is understanding the backdrop, understanding basically a summary of what's going on. And I'm going to put next to each one just an indicative time of or percentage of time that you should be spending, because obviously in trading you need to spend a lot of times doing many different things, whether it's analyzing your risk, analyzing your trade plans, analyzing debriefing, planning. So from a preparatory standpoint, it does take a lot of time to prep for these events, especially if you're a newbie and you're starting off fresh. This can take a very long time, but once you have the template in place and you've done it once or maybe twice, I think the first time you do it, it takes a while. The second time, a little bit less. The third time, a lot less. And then the fourth and fifth and sixth time, you're starting to actually build a flow to this approach. But I'd say indicatively, I'm going to put next to each section of this process how much time I think you should be spending, more or less. So with the backdrop, you don't want to spend an incredible amount of time. It's just getting the idea of of that central bank meeting or press conference or event. Um, just putting into context of what we're actually expecting, what's going down. It's more like a summary. So we're going to spend approximately 10% uh, of our time on this. Now, what is the backdrop? What is it essentially that we're looking for in the backdrop of this preparatory standpoint? Well, we just want to cover the main things, like what is the central bank mandate? Obviously, if you've been trading for a very long time, you might already know that. But for the ECB, so e.g. ECB, it's price stability. Or for the Fed, it's a dual mandate. So they've got a dual mandate of employment and price stability. So each central bank has its mandates. Just understanding what it is that these central banks actually focus on is important. So, for example, the ECB look at inflation a lot more than the Fed do. The Fed look at employment and inflation. So understanding what they're actually looking at. Then you just want to put in a quick summary. A summary of the general expectations. What's the thesis? The thesis of the meeting. So for example, coming into a meeting, you might be expecting a QE announcement. That is the thesis. Or, soon we might get potentially a rate hike from the Fed. That meeting is, the thesis of that meeting is potential rate hike, for example. Then you want to, that kind of moves into what we're looking for and when. Just please, if you're a newbie again, understand what time these things are coming out. So the Fed generally on Wednesdays, their announcements generally come out at 9 o'clock London time. And then you've got, for example, the ECB, which they've got their rate decision at 12:45 p.m. And their presser at 1:30. just understand, even if it's really simple, if you know this already, fine. But if you don't, just put it out, write it down. I need to be prepped and ready and at my desk, before 12:45. I need to be ready. I have my lunch before the presser because I know the presser is long. It's just understanding and building your schedule around it. Just putting a little mental note. Then obviously you move into the more the crux of it. I don't think I'm going to have much space to do this. So this was basically what we were covering here was basically the ECB or the Fed in a nutshell. Then you kind of want to look over. So let's try and manage our space a little bit. So next, what we'd probably be looking at is the key data development. Now, you don't have to look too much. Just look at the mandate. If I know that the mandate of the ECB is inflation, well then, how has CPI performed? If I see that CPI is moving down aggressively, then potentially they might be forced to act. If I know that the Fed is looking at employment and inflation, well, how's the last NFP? How was the last inflation print? How are the PMIs, for example? So looking at these key data points, understanding how that might affect the decision. So, if I'm getting better and better results, maybe is the market potentially pricing in a risk of a certain event taking place? So that's one very important aspect that you need to take into consideration. Then obviously the next aspect is key central bank speakers. And don't look at the ones that are not voting. Look at the ones that are voting on the executive boards, on the ones that make the decisions, or the ones that hold power. So for example, when you're looking at the ECB potentially acting, you want to look at the hawks and the doves accordingly. The hawks are probably a lot more influential than the doves because the doves are already looking for potential action or trying to act. So if you're looking at the ECB, you might be looking at the hawks to see what they've said. Because if the hawks have started to lean a little bit more dovish, then maybe we might start seeing a bit of pricing in for an actual move. And these hawks currently, you might be looking at the ECB's Weidmann. Obviously, depends when you're watching this video. That might be outdated. He might be outside of the ECB. But taking a look at what the key central banks speakers have said and how they've moved the market is really, really key in understanding how we might be looking at this. And then obviously the last part of the backdrop and something that you want to keep a very close eye on is retail expectations. And I'm mentioning this because most people coming into a central bank event, they'll say, okay, let me just read a couple articles and I can understand what the market's expecting. But you have to understand what's already out there in the news, in Google articles and research that you do on the FT and Bloomberg and Reuters. That's available to absolutely everyone. So everyone has that information. That is a level playing field of information. And at that point, that is where dumb money is looking at. So so-called retail expectations, and I'm sorry if I've offended any of the retail traders out there, but we're trying to educate you guys in how professional traders look at these things. The retail market will be looking at at the articles and saying, okay, well, these are the scenarios I should be expecting. But that's just what the retail market is expecting. Understand the scenarios that they're looking at, and what are they kind of expecting, and how are they positioned for this. And then when we look at the market pricing later, the actual market pricing, then we can see, is there a discrepancy between what the retail is expecting and what the market's actually pricing? Because that becomes then a big, big important, pillar of how we might trade this event. So we just went through backdrop. Now we're going to try and understand how we can determine the market pricing. And this, my friends, although I'll say indicatively, you should probably be spending about 20% of your time I'd say this is something you should really focus and understand first. So in the beginning, it might take you a lot more than just 20%. It might take you maybe 30% or 40% of your time just because you don't understand it as much. And I can't exactly cover this fully in depth right now, but I'm just going to just give you guys a quick overview, and then hopefully when we get to a practical example, I can show you a little bit more in depth. The first step that you take, so it basically, you take this in steps. The first step that you want to take is determine the market rates at the last central bank meeting for the curve on the close of that central bank meeting. So we look at the last central bank meeting. For example, if we're looking at the ECB, and the ECB, last ECB was on the 5th of October, whenever the date, an arbitrary date. We look back on the 5th of October, and on the market close, when the market closed, where were the rates, the short-term interest rates specifically trading? And you can determine these. So we look, I'm going to just write this out. Look at market rates, and then specifically, usually look at the short-term interest rates at last central bank meeting. And we want to look at the close. And you can determine this, essentially you can determine this from what's called, in the swap market, if you have access to this, you can determine this from the OIS, or the overnight index swap rates, or you can determine this from other overnight rates, such as the Ionia in Europe, the Sonia, or the Fed funds. So the Fed funds is a big one. If you're looking potentially at a rate hike, or the potential for a rate hike, you just look at the Fed funds rate, look at where the market's currently trading, and usually what you'll find is that the market's trading, it's probably trading at around a 99, sorry, let me just change that, 99.75 or something along those lines. This is for purely example purposes. And if you see that it's trading around 99.75, you just say, okay, take 100 minus the price, and that gives you the rate. So you'll have 0.25 there as your rate. And if the market's currently trading at 0.25, and there's a possibility that there is a hike, so that market should be trading at 0.5, so that the market price should be at 99.5. So if we were to see a hike, we'd like to see that 99.5. So 100 minus that would be 0.5. Essentially, if the market was trading at this price, then we know that there's basically nothing priced in for a rate hike. The closer this market gets to this, we know that we're getting a 0.25 or 25 basis point hike. So that's more or less how you would look at the market pricing. And I know it's a little bit quick and over the top, but when we look at specific examples, and when you look specifically into the prep videos that we'll have posted up already, and you look at how Imran, for example, goes through the market pricing, you can start understanding how you can use the market pricing to determine where the market is at the minute and where it could potentially be if they do hike rates or if they don't. So that's how you first take a look at it. The second step, after you've actually determined the market pricing for the last one, the second step, it's to determine, so you look at market rates on the morning of the meeting. It could be the morning. If you're doing the prep, I would say, do it the night before, for example, just to get the closest possible market pricing. So you take a look, okay, what was the difference between the last meeting and this meeting? So by doing that, you can actually see how much the market's moved since the last meeting, and you can actually see has there been a level of market expectation leading into the event, a scale of dovishness or hawkishness, or just neutral? So if the market was trading at 99.75, um, a month ago at the meeting, and then in this, just before this meeting that we're looking at, it's looking like it's trading at 99.80, I could see there's been 5 basis points of pricing in. So in that respect, obviously the next step is to see if there are market expectations baked in or priced in. So once we've done that, we can now understand, all right, since the last meeting, I can see that there's been quite a dovish pricing in. Or for example, in this example they were looking at the Fed funds, quite a hawkish one. So if the price, sorry, I explained that actually a little bit wrong before because we were looking at a hike. So if that had gone down actually to 99.70, then that would have been a little bit more of a hawkish pricing. So the lower the price of the future goes, then the more hawkish the outlook from looking at the Fed funds, for example. So as the price goes down, the yield invariably goes up. So that's what we're looking at, is an inverse correlation between the price and the yield. And that's why we use the short-term interest rates, because we can clearly see, if we just take 100 minus the price, we could see what's priced into the market. Obviously, there are some, if you're looking at the Fed funds, that's more of a pure product. If you're looking at the IONIAs, for example, which is a more of a bank rate, there's probably going to be some sort of credit risk also into it, which you have to take into account. But I'm not going to go into that in too much detail because we really don't have time to actually go through all that at the minute. I'm trying to keep this short and brief and look at the main aspects. If you have any certain particular questions, then you can either hit me up via email. All right, let's take a look at the next part, statement science. Also very, very key, important bit. Indicatively, I'd say probably spend about 20% of your time on this as well. It's quite important. And this is really understanding what we saw in the last meeting or the last few meetings. So we're reviewing. So in here, we're reviewing previous statements and Q&A. Now, this is really, really quite important, because if you can understand what the central bankers were looking at, and if you're going into a central bank meeting, and you can see from the last central bank meeting what, for example, Draghi was looking at coming into the meeting. So if we're looking at potentially Draghi, when you have a central bank meeting, it gives you, about an hour and a half of insight into what the central bankers are thinking. You have to take that advantage. And all you have to do is just open up a link to their website, to their main website, take a look at their last statement, highlight what has changed from the previous statement so you can see what actually has changed, and then look at their Q&A. Read over it on the train, when you're going back home, or in the morning when you're going into the office. What were they talking about? When they asked some questions, what was their tone? How did they answer these questions with regards to inflation, with regards to employment? Understanding what it is they were looking at. Are they looking at the price of oil, for example? Are they looking at the FX rate? And then you can start analyzing and seeing what could be the themes in the next meeting. So you can start seeing central bank code words. How are they phrasing things? Because if you understand how they're phrasing things, if they need to change their forward guidance or make a change to, how they're either performing outright monetary purchases or reducing interest rates, if they want to make a change, they're going to have to communicate that with the public. What are the words they're using? What was the key communication, the last standpoint? And we also want to look at the data and the economic events that they're specifically looking at, because this gives you a clue into what they might do at this meeting. Like we said before, we've already looked at the retail expectations. We've looked also at the key data development. Well, from the statement, from the Q&A, did Draghi or Yellen mention inflation? What they were looking specifically at inflation? If so, then the inflation numbers that have come out have really been quite important to them. So we need to look at the data central bankers are looking at. And obviously, like we just mentioned, overall, what we're trying to figure out from this is the focus of current meeting. Great. So we've gone through the statement science. We've understood more or less what's happened in the previous one. Now we want to kind of get an idea of how we might actually trade this event. So we're going to take a look at the charts. This is the part where we start building the actual trade plan, and this is where everything starts coming together now, guys. So you have to really, obviously this takes a lot of time, and you've built a lot of armory and understanding what's happening and what could potentially happen in the central bank. The chart analysis, understanding how you're going to potentially execute. And what you're trying to look for, basically, when you're looking at the chart analysis, is we're looking at the sensitive markets. So for example, if we're trading the Fed, we want to look at the dollar, we want to look at the bonds, look at the specific markets that are going to move. And then within those markets, within those asset classes that we know have been moving to central bank speakers, to the data that the central banks are looking at, what are the structures looking like? Is there something that we could potentially ascertain from the structure that could give us a bigger bang for buck? What we're doing with the chart analysis is seeing which markets are going to give us the biggest bang for buck. And specifically, we're looking, are the markets coiling? Are they trending? Have they been in a range expansion, or have they been in a range contraction? Because if they've been in a range contraction, if we get mispricing, if the market needs to move quickly, we might get explosive breakouts. And this is where, as we said before, this all kind of fits in. When we understand the market pricing and we can understand the market positioning, if we see a market, for example, and we could see that that market has trended up, it's now coiled for a very, very long time, and now we're currently at this point coming into the meeting. So for example, we're looking at the dollar. So let's say we're looking at the US dollar. The dollar's been trending higher, it's been coiled for a very long time. We're looking at the possibility of the Fed hiking interest rates. We could see there's a huge coil in this dollar. If they do hike interest rates and the market is not necessarily priced in for it, there's a 50-50 chance that it might hike rates, or maybe a 20% chance they might hike rates. If there's a 20% chance and they actually do hike rates, I know that this move through here is going to be extremely explosive. And I know, given this structure, I can ask for more limits, more leverage in trading the US dollar rather than any other market. And then if you say, okay, well, the dollar's coiling, and I can see that dollar's really, really strong at the minute, and it's got this coiling structure, which market is against the dollar is the weakest? So which currency pair is the weakest? So if I can see, and I'm looking at, if I'm looking at across the spectrum, I can see, I'm looking at the Euro USD, I'm looking at the cable, I'm looking at the US dollar JPY. I need to start ascertaining, is the euro the weakest? Is the pound the weakest? Or is the yen the weakest? Because if the euro is the weakest out of these three, there's no point in me trying to buy the dollar in these currencies if this is the weakest, if the euro is the weakest one. If the euro is the weakest one, I want to sell the euro versus the dollar, because I know that the dollar is going to move probably more against the euro because the euro is the weakest. Conversely, if I'm looking for a play where I want to sell the dollar, well, then I need to look for the currency pair that's the strongest. So, for example, if the yen is the strongest against the dollar, and I'm looking for a play in which I want to sell the dollar, so this is obviously a different play if I wanted to sell the dollar to the downside. If I want to sell the dollar, then I'd probably look for which market is the strongest versus the dollar. And this is kind of the analysis you need to do. Look at the charts, look at what's coil, and then look at how you're going to potentially trade it. Then you could look at every market. You could start looking at the bonds. You could start looking at the equities, and then start analyzing which one's the most sensitive to the news. And I'm going to look to take the most out of the trade, because if in that split 5 seconds that a rate decision comes out, or a big decision for QE, or a big decision for rate hike comes out, I don't know exactly which market I'm hitting. I might get caught in the headlights and I might miss an opportunity. This is where all the planning comes into place. So this obviously moves on to the next bit, which is probably the most important bit, because this is really where everything kind of comes to a head. And I'd probably say you spend about 30% of your time on this. The reason being, you've done all the analysis, you've done all the preparation, you understand the markets, but this is how you're basically making your roadmap for how you're going to trade this event. And it could be as simple, it could be as simple as basically just taking your markets. So you've got, for example, you might just make 2 markets. Let's just say I want to trade 2 markets. And we've got here this is our market. So let's say I want to trade the Euro USD, or I want to trade the S&P 500. And we've done this before in our scenario analysis. We want to look at the market implications, and we want to look at the execution. So, in doing so, for each market, you just go through the scenario, pull out scenario 1, scenario 2, scenario 3, and then look at the market implications for each market. So if I believe that in the Euro USD, if they hike rates, we should see a strong sell-off. Obviously, you might write a little bit more information of what you might expect. Execution-wise, you're going to start actually telling yourself, looking at the structure and seeing what seeing the way that market structure it's currently coiling. I'm going to hit at market for 40 to 50 ticks. Give yourself a ballpark expectation. What have I seen on the previous ones? Look back. How much have they moved? What am I looking for potentially? 40 to 50 ticks, and scale out on the way. Give yourself a plan so that when it comes down to it, in the heat of the moment, when everything's just moving extremely quickly, and everything is just moving. You've got these flashing lights in front of you. If you're trading on the ladder, you've got all these flashing lights. It's like these Vegas lights. You could just get in there and try and gamble, but if you don't have a plan, you don't have a specific plan, you might get caught in the headlights and really, really do your ring. So for example, if it's the S&P 500, if you see the S&P 500 just absolutely blip on a decision, but in your plan you said very clearly, this is a gray area. I'm not sure if this is going to go up or down. And you even tell yourself, do not trade on this scenario. Do not trade it. And when the market, for example, or let's say the central bank says something or does something where the market needs to reprice pretty aggressively, and you've said to yourself it's a gray area, if the market absolutely blips one way or the other, just if you've already at least told yourself, I'm not trading this, you're not even going to bother to look at it. But had you not said that to yourself, had you not said, this market's a gray area, I'm not trading it, and you see this huge blip in the S&P 500 down, you might say, I'm going to go with that, I'm just going to sell it. But then it just absolutely reverses, and then reverses to the upside, there's a point to the upside, then there's another point to the downside, and then it just absolutely ranges. But you're playing for the breakouts because you haven't put in your plan. Don't trade this, or at least set it to yourself. You could really, really um, do badly. You can absolutely do your ring on these kind of situations. So the most important thing is highlighting it specifically how you're going to execute and in what scenario and what you're expecting. Because if you have a mental image of what you're expecting in the price action, what you're expecting in how the market should move, then you could really execute with confidence when it comes down to the situation. You're not hesitating. You're getting in there and you know what you're expecting. I'm getting into this trade. I'm expecting 50 ticks and I'm not getting out till 50 ticks hit. Because if you had just traded your full size, you have no plan and no idea of where to get out, you might take 5 ticks and then see it go another 45 ticks and you'd be kicking yourself in the head for not actually letting it run the whole way. So this is the importance of going through the scenario bashing. And obviously I can't give you guys specific scenarios as of yet because there's no example, but you'll see when I actually go through a practical example what I mean by actually doing a very in-depth scenario bashing. And this is really the crux of understanding how you're going to execute in the heat of the moment. So yeah, thank you very much, guys, for listening in for this session of Module 10 of central bank trading. I know it's been a little bit long and a little bit exhausting having to go through all this, but please read through the notes again in the slides. Do a little bit of research. If you have any questions, again, you can get in contact with me. But hopefully, when we actually go through an example, it'll come together a little bit better. So thanks very much, and stay tuned for the rest of Module 10.